growing online business, improving our customer experience, strengthening our product portfolio, and in ensuring a very robust supply chain, which is robust and agile. Let me take you through some quick highlights before our CFO details the financial performance for the quarter and for the full year. Our full year revenue has grown by 23.2%, whereas the volume has grown by 13.1%. Q4 revenues have grown by 12.8% year-on-year and 20.8% quarter-on-quarter, whereas volumes degrew by 14.6 and 19.2 respectively. EBITDA margin degrowth for the quarter can be attributed to higher product cost and under absorption of other overhead. And as I told you before, we are taking measures to control all our expenses as we move forward. As we reinstated normal advertising spends this year, a good share of that was invested during Q4. As of March end, we are present in 120,000 plus MBOs, 1,289 EBOs, and 3,000 plus investors. Our channel expansion continues to be in line with our plan. And we are also happy to inform you that our e-commerce business has grown by 41% in Q3 and 34% in Q4. I will now let our CFO, Mr. K. Chandrasekhar, to give a detailed view on our financial performance, after which we would be happy to take your question. As usual, on our panel today, we have our CFO, and I'm also joined by Mr. Gagan Sehgal, our Chief Operating Officer, and Mr. Rahul Shukla, President and Chief Retail Officer. They'll be more than happy to answer any questions that you may have in their respective domain. Thank you once again for joining the call today, and over to Chandrasekhar.
Thank you, Mr. Ganesh. Once again, welcome you to the Page Q4 FY23 earnings call. FY23 results were good. We clocked 47.86 million compared with 38.886 million, as some of you would have noted. This is a growth of 20%. The volume had a 13% growth to nearly 216 million pieces. EBITDA showed a growth of about 10% to 8627 million. The margins are at 18%. EBITDA margins are at 18%, compared with about 20.2% in the previous year, due to sales-related expenses and advertisement investments. The FY23 PAT is at 5712 million, which is a 6.5% growth over the previous year. The PAT percentage is 11.9 compared with 13.8. The quarterly Q4 performance has not been up to our expectation due to the external environment, and that we did not achieve the revenues we were planning. So we ended up at 9691 million, which is a degrowth of about 13%. Quarter on quarter, there's also a degrowth of about 21%. The EBITDA reported at 1,345 million compares with the 2,671 million year on year, and this is a degrowth of 50%. Quarter on quarter, there is a degrowth in EBITDA of 30%. The EBITDA margin are at 13.9.
Sorry, unable to hear you.
Are you able to hear me now? Sorry, the EBITDA margins are at 13.9, and it compares with 24% year on year and 16% quarter on quarter. As explained by MD in the opening remarks, the margins are impacted due to COGS of 2.6% and 7.6% OPEX, and because we could not achieve the revenues, the absorption has been. While we have not stopped investing in advertisement, but the absorption of all the OPEX has been lower. If we had achieved the kind of revenues like year on year, we would have been at about 70-80% EBITDA. The Q3 PAT, profit after tax, is at 784 million. It's a degrowth of 59% and year on year. And quarter on quarter, it's a degrowth of 37%. The PAT margin, therefore, are 8.1%, compares with year on year 17.1% and quarter on quarter 10.1%. Inventory has also been at an all-time high so far. So we are close to almost 15,950 million, and quarter on quarter it is about 14,963 million. Inventory days are 120 against 92 of the previous year, and of course, due to the lower revenues and volume, the inventory is taking much longer. As you know, we had done advanced inventory. We planned for advanced inventory inventory in anticipation of growth, which didn't happen. So therefore, the inventory will take longer to liquidate. The net working capital is at 7,710 million, compared with about 8,045 million quarter on quarter. The working capital days at 59 days are generally in line with the previous year. So with this, I hand over for the Q&A question, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, thanks for the opportunity. First question pertains to the growth side. So despite Omicron base, if I see YOY degrowth looks a bit loud in numbers. So just wanted to understand if you can give some more read on the slowdown that we are witnessing, and how, in your assessment, how early you see this demand sentiment turning around for us.
Okay, thanks for asking this question, Tejas. And there are two parts to your question because for us, this is part of this market, and second part is because we also knew what we are getting into when we are implementing the auto replenishment system. So, if you look at our Q4 performance, yes, the market has been subdued, and we actually expected Q4 to be, from a market sentiment point of view, much better than what we thought it is going to, what actually turned out to be. So that did impact, and we also were bracing ourselves for some initial setbacks as far as ARS is concerned, because during the pandemic, the distributor inventory became very lopsided because they were buying based on what is available rather than what is required by the market. And the demand also, there was a huge demand shift which the market witnessed. So both of it didn't help. This is also one reason we thought we would rather take that bitter pill and accelerate the ARS implementation, because the faster we do, the better. So, and this is a very complex and very, the sheer size of this transformation is so big that we were expecting few quarters of tightness, but the market not being so buoyant also didn't help us. As you know, Tejas, we have 4,800 plus distributor accounts, and we know that this is going to take time, and we need to go at SKU basis, because what actually happened during the first phase was that the core size, they were having extra inventory, and that was coming down, but it was not triggering a reorder. And the other styles, which are potential winners for us, which were not actually purchased. And this is also to do with the liquidity in the market and other aspects. Now that we have got some help on these, we are able to push it further. But this is a very, very important transformational project for our company, which will help us for quarters to come. So it is good if we tighten ourselves for 1 or 2 quarters more till we cross the bridge. And we are taking all necessary action to protect our margins as we move forward and implement this flawlessly.
So is the peak phase of this transition behind us, or you believe, as you said, 2 quarters more? So should we expect that that peak will be in the coming quarter of this transition?
It is a tough question to answer, Pages. Why? Because it is very difficult to dissect how much is because of this ARS transformation and how much is because of the market, which is not buoyant. If we think, by later half of Q1 or in fact, by June, if you think everything, things would start moving around, we will definitely see huge improvements. In fact, we are already seeing some improvement, but this will be much better than what we are thinking. So we are bracing ourselves. When market improves, we will be the first guys to bounce back. We are all ready for it. personally, if you ask me, I think we have seen the bottom of it.
Second, if you can give some color on the current slowdown in terms of qualitatively, are you seeing it much higher in certain category or channel?
It is across the channel of mine, basically, because as you see, we had a pretty healthy growth in the online channel. So we are trying to understand, why this is happening. But if you see across, it is across, and we think the consumers are postponing the buying, and it's question of time because luckily we are in the discretionary space. So we will be the first ones to recover. That's how we read it.
So, as a last one, if I may, would you take any pricing intervention to revive demand in terms of cutting or?
We are fairly priced. I think we are a value for money brand, and that we don't see any immediate need for a price intervention. Because if you see, we have performed, despite all this, we have performed better than many other brands. So, price is not a barrier for us. We don't see an immediate need for intervention.
Thanks, sir. That's all from my side, and all the best for coming quarter.
Thank you, Page.
Thank you. We have our next question from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for the opportunity, sir. So my first question is in regards to the high price inventory of cotton. So is it now over, or because of the subdued sales, we do see still the high price inventory being carried in the inventory?
Gaurav, yes, since we were carrying a lot of inventory, the high price of cotton, we did have that impact in Q4, but the benefits have started flowing in. I can say even as late as March of Q4, we have started seeing the benefit. So we have crossed that bridge.
Okay, so thank you. So my next question, is with regards to the demand pattern only. I mean, we had seen some demand volatility over the past couple of years, with some sharp demand across the industry due to the COVID pent-up demand. And now this demand seems to be normalizing either by way of lower consumer demand or ARS implementation. So on a CAGR basis, do you think that would be the right metric to look at the demand? Or do you feel, this impact is temporary and we might see the old demand coming back?
I frankly, Gaurav, the market looks very subdued. So I think it will take some more time for the old demand to come back. We are actually patiently watching and be ready to bounce back the moment the market recovers. So it is because generally across trade, the inventory is very high. The inventory levels are very high. There is tightness as far as liquidity is concerned. So I think it will take some more time for recovery to be seen.
So, sir, thank you.
Thank you. We have our next question from the line of Ashish Kanodia from Citi. Please go ahead.
Yeah, hi sir. The first question is on inventory. So, when we ended 3Q, our inventory level was already very high, and given that, the demand scenario doesn't look very buoyant, what led to inventory built up even quarter on quarter in 4Q?
There are two reasons, Ashish. One is, of course, the demand was not as we anticipated. But the second part is we had a high level of raw material inventory. This is because, as you saw, H1, the demand was so high and the market was so buoyant, and nobody predicted this kind of a drop. And therefore, the supply chain was gearing up for a high operating level, and they were purchases. During the pandemic also, as Chandrasekhar rightly said in his opening remarks, during the pandemic also, we built inventory because the supply chain was so disrupted. We did build inventory. So what we did was we converted this raw material to finished goods because we have to keep our operating cost at an optimum level. We need to utilize our capacities. So we made sure that this inventory buildup is healthy, and we made sure that what we are producing are our core styles, so that we don't have this threat of slow-moving, non-moving inventory at a later point of time. So it was a balancing act of utilizing our inventory to utilize the capacities we have built and thereby manage the operating costs and also have a healthy inventory as finished goods. So this, we are very optimistic, will normalize as we move forward because we have tuned our supply chain in such a way that the supplies going forward are going to be lower than what we are going to sell so that we can bring the inventory levels down. So you will see quarter-on-quarter improvements as far as the inventories are concerned.
Sure, sir. And the next question is on the demand front, right? So, I mean, while I understand, there is some impact coming from ARS and, channel inventory being high. So, I just want to understand from two perspectives. First, if you can give some sense on, how the like-for-like sales for EBOs has been, because that gives a much clearer picture in terms of, the real consumer demand. And the second thing is, if you can, qualitatively state, between the categories, say, men's innerwear, women's innerwear, and athleisure wear, relatively which category, from an overall company perspective, suffered more volume decline and which did relatively better?
Okay. So to answer your first question, Ashish, the EBO demand was, growth was in line with our overall. So, and that's a true reflection of the demand. But we did see some softening in the last couple of months, say March and April, and that actually is a very true reflection of what is happening in the market. That is the best way we can sense it. So that's where I told you before that, the market is not on that point. Coming to a category, of course, we can see this happening across categories, even though some of our premium products seem to be faring better, but it is across categories. And there is also some shift in the consumption pattern as far as outerwear is concerned. So it is moving more away from at home wear to the athleisure. So there is out of home wear. So there is a shift which we can see. And that has actually caused some disruption across the market. I'm not just talking about Page or Jockey. Across the market, we can see that. But that is something which is question of time before it normalizes. But there's definitely a demand shift or a consumption shift in the outerwear space.
Very helpful, sir. And this last question, if I may ask, is on the margins front. I think, you in the opening remarks, there was some discussion that there was some impact of 2.6% on COGS and 7.6% on OPEX. If you can elaborate on that, and also looking into FY24, do you still maintain the margin guidance of 20 to 21% or any change in that? Thank you.
Casey, you want to take that?
Yeah, I explained earlier, we can in the die sides, premium packaging, liquidated, not selling agility today, or we cannot be higher the impact on the market. At the same time, on the OPEX, while we haven't overspent in terms of OPEX, particularly in Q4, we had about 1% more on the advertisement. Actually, 1.4% we spent more on advertisement on the revenues of the respective quarters year on year. Also on selling overhead, we had spent about 2.3%, and that is largely due to the trade engagement and the commission you pay for the e-com market. And in e-com, the universal growth, the market growth commissions were more than last year. So these are two of the significant items. We also had other, in absolute terms, the salary is not too high in Q4. We also had about 2% more on the corporate, on the staff salary. So these are not really explaining the 7.6%. Your other question as to the guidance. So in terms of, that why we do not for your guidance or forecast, what I can tell you is that if we had, we get 991 revenues for this quarter. If it was 11,111, which we achieved last year, Q4 we would have taken EBITDA percentage of about 17.5%. So definitely our aim is to get back into making the 20% the margin. And but also it's supported by, the inventory cost will be coming in lower in Q1 and more so in Q2. So that would be rather than increasing the price, we said our approach would be to tighten the cost and improve the revenue. So we will definitely get back to that range. So something we look at as another economic for Q4 and a bit of Q3 concern.
Sure. Thank you, Casey. And this, if I can add on what Casey said, we have made a conservative budget and have tuned the expenses to be in line with those budgets. And we also done enough work in our supply chain so that we can actually take care of the upside that when market bounces back. So, we will have, as Casey said, there will be a tremendous margin recovery as we move forward. There is no question about that. And on the spend, Casey was also speaking about advertisement, and that is something which we are going to stick to because we are very bullish on the long term, and we are not going to cut those costs because these are necessary, because we have a very rich product portfolio. The consumer will be excited to discover them, and we need to facilitate it. So we are going to go all out on those aspects because our long-term outlook is very bullish. And what we are going to do is to control all the other expenses, which may not be customer-centric, which are nice to have for a long-term growth of the company, which we will do when things recover. We will go aggressively and pursue those options.
Sure, sir. Very helpful. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to answer queries from all participants, please restrict your questions to 2 at a time. You may join back the queue for follow-up questions. We have our next question from the line of Avi Mehta from Macquarie. Please go ahead.
Hi, sir. Sir, I just wanted to,
Mr. Mehta, we cannot hear you.
Sorry, am I audible?
Yes.
Hello?
Yes, please go ahead.
Hi, sir. I just wanted to better understand this demand environment a bit. I mean, without necessarily why you are not able to give an ARS impact in your understanding, the demand trend would have weakened further from third quarter levels in this quarter. And should I read that comment on recovery as a sense of that changing as we go into the first quarter? That would be the first part, sir.
You are right, Mr. Mehta. According to our read, the demand has slackened further in Q4. In fact, we were thinking it will be as bad as Q3. We never expected a further slack, and that is what gave us a bit of a surprise. But now we have braced ourselves to the reality and taken necessary corrective action. But you are right, the Q4 demand seems to have slackened further. And when I see the numbers across retail, it is further making it clear for us that demand seems to be got more subdued in Q4.
That changed in first quarter, sir?
As of now, we are seeing some improvements. Definitely, we are seeing some improvement. But again, it may not be comparable to our last year Q1 because that was a record year for us, and H1 was so good last year, so it may not be comparable. But if I compare to Q4, I can definitely see some green shoots emerging.
Okay, and so the ARS impact is going to be there for 2 more quarters, right? That's what you also said.
Yes, it is going to be, but we are prepared for it. We will be managing this very, very carefully. So from a overall numbers point of view, I think we are seeing the bottom of it. But ARS, yes, 2 more quarters is going to be the transitionary period as we read it. It can be shortened if the demand picks up, and if the inventory starts flowing out of the system, it can be hastened. So I'm talking about the worst case scenario.
And sir, sorry, if you can give us a sense on the pricing, because we understand from the channel there is some hike that we have done, which is our annual hike. Is that understanding correct? And if you could kind of just clarify that part.
Well, we did a price hike last year, 3.6%. And nothing beyond that. I mean, we don't see an immediate need for any intervention.
Okay, sir. Perfect, sir. And that's all from my side. Congratulations to Dipanjan being your appointment. And thank you, Chandrasekhar, sir, for all your clarifications.
Thank you, Mehta, for telling that. And let me take this occasion to, on behalf of the board and the senior management of Page and all the associates of Page, to thank Mr. Chandrasekhar for the tremendous job which he has done, and wish him a very happy retired life.
It's been very helpful. Thank you very much. Thanks.
Thank you. We have our next question from the line of Nihal Mahesh Jam from Nuvama. Please go ahead.
Yes, sir. Thank you so much and good evening to the management. So one clarification on the ARL discussion, that isn't it possible to get a sense of the impact by looking at the secondary to tertiary sales ideal? Because that in a way would give us a sense of how the market demand has been, and obviously the lower replenishment would in a way give us the sense of ARS. Would that be the right way to look at it?
Absolutely, it would be the right way to look at it. But our visibility as regards tertiary will be a bit clouded, because we can't get a real time and exact visibility on that. Secondary, we get a very clear visibility. So that is, as you rightly said, one way of looking at it. And the second is, since we get good end-to-end visibility on our EBO side, that is a good indicator. And that's where I said, if you look at last 2 months, there seem to be a enhanced subduedness.
Got that. And if I could follow up on that in earlier part, you have given an indication how the secondary sales have been that you have visibility. Possible to just give a sense of how that number was for Q4?
Well, our secondaries, when you implement ARLs, your secondaries are bound to be a bit more higher than primaries, because you are actually flushing away the inventory. And that is a trend which is happening. And that's why we said, there will be immediate here, because the secondaries have to outpace the primaries in the immediate until the distributor inventory normalizes. And from there, you hit a great rhythm. So across the year, if you look at it, the secondaries and primaries are matched up. Your secondaries are in line with primaries.
Definitely add any project coming. The secondaries in Q4 were actually marginally higher compared to last year. So it was the ARS, in fact, the liquidity and is getting for the market is getting the damage with the liquidity and the related link.
Got it. I think that was helpful to give us. I had another question on the athleisure bit of it. Last year you did highlight that there was a category which has been growing pretty well. And even checks as well as a lot of other commentators are saying that the category is facing pressure as the athleisure consumption somewhere is moderating. From our side going forward, what are the initiatives that we are taking to see to that this category continues its long-term growth, or maybe at least matches up to the growth that it's seen over the last few years? If you could just highlight some of them.
Athleisure, the line was not clear. I think you were asking about athleisure, right?
Yes, my question was on athleisure, that the market is subdued at this point in time. What are the initiatives from our side we are taking to see to it that the growth sustains even post the COVID bump that was seen over the last 24 months?
Okay. So if I look at it from a long-term perspective, as a country, this is one category which is going to grow tremendously, because there is the lifestyle change, there is a high fitness awareness, and therefore this is one category which, if you see any commentary, everybody is in unison in saying this is one of the emerging categories which is going to see accelerated growth. Now, what we are seeing is a temporary bump. This is also because if you look at like-to-like, during the pandemic, the consumption was high. In fact, many brands, including us, what would have taken 3 years to grow, we achieved in 1 year. And when you compare against that, you obviously will hit a bump when there is a correction. So our long-term view is very bullish, and therefore we are leaving no stone unturned as far as product innovation is concerned, launching new products. We are going to go all out and giving all the necessary attention to this category. And We are having more exciting products in the pipeline. We are looking at upgrading our existing product portfolio so that there is much more value for money for our consumers, and our consumers deserve that. And we are also going to come with more exciting products which will cater to the cross section of our consumers. Be in the lower end to the premium side. So we are looking at the cross section of it and going to launch more products which are going to be more friendly for all the category of people.
Got that. Mr. Chandrasekhar, thank you so much, and I wish you all the best. Thank you, team. Thank you.
Thank you. We have a next question from the line of Manish Poddar from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for being the opportunity. Friendly three questions. One is, any sense on market share you would have, let's say, in the men's segment, or let's say fully FY23, or let's put it.
Well, Manish, as you know, there is no syndicated study on the market share. As far as a market share official numbers are concerned. So what we do is, I can say we can talk about the penetration looking at our PG. And if you look at it that way, we are in the high teens, say around 17-18% market share on the men's internet. And that's where we keep saying there's so much headroom for us to grow. And as far as other categories are concerned, even though we are the most dominant players in most of the categories, we are in single digits.
Yes, sir. Where I'm coming across is, have you gained market share by your trade checks? You'll be doing, just through the sales channel and stuff like that. I'm just trying to understand, any sense where your market share is in the category, the men's category largely.
So that's where, as I told you, as far as men's innerwear is concerned, we are at around 17-18%.
Has that increased? That is what I'm getting to understand.
Pardon?
Has that improved? Is what I'm trying to understand for the full year?
No, we are in that zone. So if you're asking whether compared to last year it has improved, I can say we are held ground. We are more or less in the same zone.
Okay. And just the second part, so how much is the inventory in the trade? If you can just help me understand that in terms of number of deals. Because in April, you were roughly at 35 deals.
Again, you want to take that?
Thanks for the question. Are they in the NLP level above the distributor level or the trade level?
At the trade level. Because it was 75 deals last quarter. In the earlier comments you mentioned, to optimize the capacity, you put in some inventory in the trade. Now that is relatively higher. So I'm just trying to understand what does relatively mean.
We typically operate at around the 50-55 day inventory at the trade level.
And what is that number right now?
So currently also we are maintaining, as per our information right now, we are maintaining at around 48 to 50 days of trade inventory.
So would that be a fair understanding that the inventory in the trade is at normal level? It's not higher. Just the demand is lackluster.
Yeah. The inventory at a trade level in terms of placement of our products, we are where we were. So, in fact, for all our product lines, there is no way that the inventory has come down. We are still maintaining and sustaining. Then it's a reflection of tertiary in terms of replenishment by the distributor.
So okay. So, and just one last one. For the full year 23, any sort of broad, sales cut or by categories, just broad headline, let's say 30 to 35%, any sort of sales cut, across categories? That is helpful. Thank you.
And more or less the growth that we have mentioned for the year has been in line. All the categories have almost grown at the same level itself. There's not too much of difference.
Sorry, can I fill in one more?
Yes.
So, just your initial comment then, if the channel inventory is in fine shape, why are you mentioning that the AIF implementation will take some more time?
See, what happens is that at the trade level, the inventory is at the right place with the MBOs. Whatever the MBOs want, they are supplied, right? But when there was a supply issue at that point of time, the distributor bought a lot of inventory. Maybe that was not relevant at that point of time. So that has not gone to the trade. That remained with the distributor. So the distributor inventory level went up. So with the implementation of ARS, right, the distributor inventory is getting corrected as per the market demand, because then he will only keep what the retailer wants. So rather than the inventory level of the distributor going up. So this is the reason where the distributor inventory levels have come down. There is a correction. right? And he's only through ARS, he's only getting what actually the market really needs. So it is not at the retailer level, it was at the distributor level.
And sorry, just this same number of 55 days, what is the same number at distributor level last quarter versus this quarter? And let's say, or let's say, what is the optimum number versus now?
So normally at a distributor level, it depends category wise, but overall we maintain a 45 to 50 day inventory at the distributor level.
And what is it now?
So the distributor level has got corrected by almost 20-25 days, what it used to be earlier.
So, but it is still 60 or 70 days, or it is at 45 days only?
It has now come down to the 45-50 days, which is the optimum level. And that is the inventory correction that has happened where the distributors were keeping the extra inventory, which was not as per the market. So the most of the correction has already happened, and there's 20-25 days of inventory correction that has happened at the distributor point. And currently the distributors are at a healthy 45 to 50 day inventory.
So let me also clarify this. Even though the number of days might have come down, the inventory is lopsided. And this is where we are working on the ARS, wherein at a SKU level, there will be a curated prescription as to what has to be bought, and that will be system driven, so that the 48 days is healthy inventory, because today the distributor goes by his gut and he keeps buying based on historic data, and he doesn't see potential future winner and he doesn't invest on it. This is where the skew comes. And this is where we are trying, this is why we said, this is one of the most important initiatives for us, especially with the kind of volatility we are seeing in the market. Unless we have a pull system, and if we keep pushing, and when there is demand volatility like what we have seen in the last 2 years, this is going to have so much supply chain peaks and troughs. And the best way to do it is to have a pull system. So yes, 48 days is there, but we still have work to do on this plan.
That's perfect, because actually, if you take 20 days delta change and you do, let's say, 10 crores sales per day, you are doing a 200 to 250 crores sales loss. The only basic piece, just as a comment, is I fail to understand EBO was growing the last quarter, and now when you're seeing EBO is growing in line with the company, so, EBO sales have also declined materially. So that's the only, dichotomy. But nonetheless, thank you so much for your reply.
You're very right, and that definitely on the EBO side, that is an indicator of the subdued demand.
But great. Thank you so much, sir.
Thank you.
Thank you. We have our next question from the line of Devanshu Bansal from MK Global Financial Services. Please go ahead.
Yes, sir. Hi, thanks for the opportunity. In Q4, we saw launch of denim category in our review. So just wanted to understand thought process behind this and the current distribution for this denim.
Rahul, you want to take this?
Sorry, I didn't get the question. Could you just repeat your question, Subhakar? Yes, the question was on launch of denim category in EBO. So wanted to understand the thought process behind this launch as well as the current distribution of this denim.
Oh, launch of woven category. No. Rahul, I got this. I think the question was the launch of denim category.
Oh, okay.
So, Mr. Bansal, this was more of a test which we did. We actually wanted to feed the pulse of the market, and we are continuing with it. But as far as the work leisure space is concerned, we need to be cautiously aggressive when we are embarking on this journey. So we are launched this product to see how the consumer expectations and how it is evolving. So we, this is actually to take that category further forward.
So how has been the learning, sir, and what is the plan for distribution expansion for this denim?
The learnings, it is well received. I can say the market is very excited. In fact, the very fact that you are asking this question itself shows that, it is positive, and that is the feedback we are getting from the market. And this actually gives a great sense of direction to our product development team as to how to take this category forward.
Got it, sir. And second question was if you could provide the comparable gross margins that we used to report in the PPT, and this time around we have not reported.
I do, the line was not clear. I didn't get you.
The comparable gross margin, which we used to report in the PPT, and this quarter we have not reported, which is around 40% or we had about 41% Q4. And can you hear me? Yes, sir. Yes, 41% in Q4. Yeah, and last year, and this year we had 38.2. 38.2. And this, if we could indicate how has the movement of this gross margin been during the quarter, as you indicated that the cost, high cost inventory was used earlier in time, and then in market sort of started to see the benefit of that. So if you could just throw some light on that. We are definitely in 39 to 40% range. Some quarters are an exception. Last year was an exception on the higher side. So the 39 40 is largely maintained. And I think going forward, if the inventory costs are going to go lower, then we would see better gross margin. Got it, sir. Thanks. That's it. Bye.
Thank you. We have our next question from the line of Ankit Kedia from Phillip Capital. Please go ahead.
So 2 questions from my side. So the old products which the distributor would have bought, in the peak COVID time, which he should have bought, has those products been taken back by the company, or you have liquidated that in the channel, in last 2-3 quarters?
Sorry, Ankit. We usually don't take it back. So it gets liquidated in the due course of the business in the channel.
So when you say the inventory days at the distributor level was come down, so the fast moving inventory would have only got liquidated, right? Because even the slow moving inventory would still partially be at the distributor level and create an issue in the ARS first.
Yes, so that obviously will not trigger a new order. So, there will be no top-up happening for those products, because it usually works on a mini bag, so it will not trigger an order. And this is where I said, as we implement this, these kind of aberrations won't happen as we move forward, because we will be replenishing at bite size, and with all the work which we have done in supply chain on quick turnarounds, we can quickly replenish. So they need to be very smart, and we need to curate the distributor inventory to the best possible level and have a good presence across the SKUs.
And sir, historically, the new launches were not part of the ARS. Now, are the new launches part of ARS for the distributors?
Going forward, it will be, and it has to be, so that the new product gets an opportunity for the market to decide on its how to receive it. So it gets a fair play in the market. So it has to be in the ARS.
And so one last question. So Q1 is the best quarter for you historically. Now with demand environment being low and the ARS issues partly getting settled, in Q1, do you see your A&P spends continuing to be high for the full year, or you will curtail your spends, your efforts to maintain your margins?
Which spend you were talking about, Mr. Ankit?
Sir, advertising spends, because even in Q4, despite the low demand, we continue to spend on advertising and promotion.
Yeah. See, Ankit, when you look at it, you have to look at it as a percentage of revenue also, because if you just look at quarter to quarter, what happens during the pandemic, we were kind of media dark and we didn't spend much. So it may look very high spend, but if you look at it as a percentage of revenue, we are going back to the old normal at which we used to do the spends, and that is absolutely essential, because see, these 1 or 2 quarters, we see this as a temporary thing, but if we have to sustain our growth and do justice to all the products which we are offering to our consumers, we can't continue to be media dark, and we need to make the necessary spend. So what we are planning to do is to cut other costs which can be passed or can be avoided, but we don't want to kind of subdue any expenses where it matters. We want to go all out. We are very, very confident as far as long term is concerned. So we have a very bullish outlook. So we are not going to cut corners as far as the necessary spends are concerned.
So, and so one last question, if I ask, from 1st of April, you set up a new division for accessories with a separate sales structure. So if you can just highlight what is the growth opportunities you are seeing in accessories category, and how should we look at that apart from, the innerwear and the athleisure category?
So accessories, yes, we created this division because, we started doing this few years back with the introduction of towels. Then we had handkerchiefs, socks, and then we had caps. So all this were showing very good traction and was getting well received. And when it reached a particular point when we saw the acceptability of these products and the category, we decided that we need to create a division for this because the potential is there and we can further take the business forward. So we have done this because we can see the huge potential in front of us, especially for socks.
And would this division be approximately double-digit revenue contribution for Page today?
We usually don't give those specific numbers out. It's your interest and our interest that we don't say that because it will be handy for the competition. So we don't give those splits actually.
No worries, sir. No worries. Thank you so much, sir.
Thank you.
Thank you. We have our next question from the line of Akhil Pare from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity. My first question is in terms of a demand scenario, right? I mean, you already elaborated, but Jockey has gone through that cycle in FY19. The demand kind of started to curtail from fourth quarter of FY19 to it elongated till third or fourth quarter of FY20. So how similar or a different demand situation is today versus the discretionary slowdown that we had seen during the back end of FY19 start of FY20? That's my first question.
It's correct. I think we will have to generally look at the state of the inflation and the economy and what is happening in the retail space. That is what we are going through. So I don't think we are an exemption to it. Otherwise, I think as far as sustained growth is concerned, we don't see any problems. If you see our retail expansion, it has increased so much, and we will be able to milk it as we move forward, and we are going to continue to expand, as I told you in my starting comments, be it the EBOs or MBOs, we will have continued growth. And compared to 18, 19, we have much more exciting products to offer to our consumers, and we are in a sweet spot. So this is a temporary bump through which we are going through. But if you look at it long term, there is nothing which we see can stop us.
Okay. So would it be fair assessment to say that where we are right now, is largely driven by the macro situation and to some extent because of the ARS implementation, and there is absolutely no increase in competitive intensity from any of the regional players across the country?
Absolutely. Because see, the kind of market penetration I spoke about, there is room for competition, and for us, it has not, saturated wherein we are 60% and the other part of the market at 30%. There is so much headroom, and these are also growing categories. If you see, men's innerwear is supposed to grow compounded 10.5%. Women's innerwear is slated to grow at 13%. So we need to accelerate and grow faster than that if you have to gain market share. That's the kind of potential which is ahead of us. So if you look at it that way, we should say our competition is awesome.
Especially last question on the margin front, like in the past, historically, we have
very confident about maintaining at 21 to 22% of EBITDA margin. And by and large, we were able to achieve over last many years. Will you be able to give any kind of color or guidance with what kind of EBITDA margin we should look at in FY24?
Well, as Mr. Chandrasekhar said, as a company, as a policy, we don't give guidances. But all that I can tell you is that, this is because, when you take cost control measures, the juice doesn't flow overnight. It takes time. So, all that action which we have taken, it has started materializing. So, there is a tremendous margin recovery which we can promise. So we will be in a zone as per our budget where we are comfortable. So historically, as you rightly said, we always look at 19 to 21% levels. I'm sure we can get close to it, and if the market recovers in the second half of the year, we will be in a very comfortable zone.
Fair enough. Thanks a lot, and best wishes.
Thank you. We have our next question from the line of Varun Singh from ICICI Securities. Please go ahead. Mr. Varun Singh, your line is unmuted. Please go ahead.
Audible?
Yes.
Okay. Thank you, sir, for the opportunity. So my first question is on the macro slowdown in the category. So, sir, if you can just let me first understand, and then given that it is the innerwear is an essential category and 17 to 18% in the penetration, 10% in the growth rate of the category that you called out. And so, what should be the basic reasoning for such a steep decline in our revenue or in minus the software implementation issue? So, how should we read it? Because, technically, there is an inflation, there should be a down trading. But even on volume front, etc., we see kind of more of an impact. So, what are the other possible reasons to be ascribed to our current growth number? Do you think the competition over here has a larger role to play, or you think any other trend observation? There is a brand fatigue given Jockey now more than 25-year old brand. So. If you can give some more color that why into an essential category which is so less penetrated, there is such a steep decline in top line growth.
Thanks for asking this, Varun. And let me tell you, I don't think it's a competition, because if you see, they are not exception to what we are going through. Everybody is going through the same patch. So definitely it is not the competition intensity. It is because, if you see the distributors also, when the supply was low, they were all trying to get hold of stock. Everybody over-inventorized. And now they're all trying to liquidate. There is also a liquidity issue in the market. So everybody is tightening the belt. And that's where the path, we are going through that patch. And this is what exactly happened in the US also, if you see the similar trend. So we are no extension to that, and I won't attribute this to competition intensity. And with coming to brand fatigue, definitely not. In fact, today if you see our designs and styling, these are all catering to the young consumers, and the way it is received by our consumers shows that there is no fatigue. And this is backed up by the brand equity studies which we have done, and we have got very, very positive feedbacks wherein we are way, way ahead of all the other brands, and the distance between us and the others is so high that we are very confident that we are going the right direction. And this is true as regards men and women, both categories. In both places, the brand equity study shows that we are way ahead.
I get it, sir. Understood. And sir, my second question is now that it's been more than 5 years that we launched a Jockey Women, and
but still kind of we are not pointing out segment and contribution separately, and which is fine. But given the smaller base, I also recall that we called out that all the segments have grown at a similar rate during the quarter. Ideally, we should be expecting a higher growth rate from women and kids wear. But still, and also like I was kind of doing some bottom-up research, and I put the potential to say that not many companies are there which operate in both men and women wear with the same brand name. But still, how should we read our aspirations, especially in the women and kids wear category? I mean, I understand that during the past con calls we did highlight that we have witnessed a relative structure in this category, and they would be more than happy to see the category growing at a much faster rate. So the current growth rate, which is similar to other categories, which like as an analyst I would be expecting to grow at a higher rate. How should we read these things, and hence our potential objective aspirations in both these segments?
Very, very good question, Varun. Actually, you are right. What you are asking is, since we have a lower base on women, we should be growing faster there. And we said we have grown equally across the board, which is true. And this is where we are taking all the necessary action to have accelerated growth of women. In fact, if you see the previous year, we did that, but this year was an exception. But we are now making all the right interventions to have an accelerated growth on the women's innerwear. Juniors actually have grown, and I would say that's also because of the low base which we have. And as far as juniors are concerned, we have kept our own trajectory. We are not trying to conquer and dominate the market. We are present there, and we are working to a plan, because that is a very, very, very different category when it comes to design, styling, go-to-market. So even margin structures vis-a-vis the competition. So we are in a sweet spot. We have achieved what we want to achieve there. And in fact, this is a category which will help us to recruit new consumers. We are achieving the objective, and we are looking at a healthy growth on juniors. And it is on track. Women's, you are right, but we are taking all the necessary action to have accelerated growth. And as you watch the market, you'll see a lot of action from our side in this trend.
Got it, sir. And just one last question, if I may, that on payable, what the reasoning for decline in the payables or base, sir? I mean, that's a bit.
So, Varun, I didn't get you.
Sir, our overall the trade payable there, so that there is a reduction out there. So, is there anything to call out over there, or nothing as such?
Okay, Casey, you want to take that on the trade payable base?
It is not very significant decline on the day. I mean, after we have been buying less or purchasing we have been less, it is more a matter of timing of relevant suppliers. Okay, sir. So ideally it should be roughly 20 to 25 days between that. Yeah, it is about 27, and in the previous quarter it was 29. So it is not very different. Okay. Yeah. Okay, understood. But that's on my side, sir. Thank you very much. And
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Chandrasekhar K, CFO, for closing comments. Over to you, sir.
Thank you. Thanks to all of you who have been guiding and holding listening patiently to us. And as always, appreciate your support for the management of Page Industries and keeping faith in all that we do. Wish you all the best. Thank you. Bye-bye.
Thank you, sir. On behalf of Page Industries Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.